Hello, and welcome to our latest market forecast for 2023. Despite a challenging start to the year, a recession has been avoided, and the continued easing of supply chain pressures have been a key factor in boosting activity. We're seeing positive signs of the resilience of the UK construction sector. Today, we're going to cover a macro overview of market conditions. Mike will cover construction output and material pricing, while Andy will cover energy, transport and labour costs. Let's dive into the macro overview. Growth prospects have marginally improved due to falling energy prices and increases in global trade. The Bank of England have announced that they no longer expect the UK to enter a recession later this year. However, we still face challenges. Inflation remains stubbornly high. We have falling real incomes and rising interest rates, which are affecting growth. Construction activity, however, is experiencing growth, although it is not evenly distributed across all sectors. The residential sector faces challenges due to new legislation and higher borrowing costs, leading to reduced demand. Offsetting this, we have commercial building and civil engineering activity increasing. Overall, the construction sector remains in expansion mode.
In Q1, UK construction output, which is a measure of the amount chargeable to clients for construction work, reached a new quarterly record of £46 billion, growing by 0.7%. The biggest driver of output growth was repair and maintenance work, which increased by 4.9%. However, new orders dropped significantly in Q1 this year, contracting by 12.4% and falling below the 5-year quarterly average. Despite the uncertainty in Q1, the economic outlook has improved. The alleviation of bottlenecks, certain cost pressures and material shortages may boost confidence and encourage progress on construction projects. Now, let's turn our attention to materials. According to the data, material prices in March 2023 were 8.7% higher compared to a year ago. This is primarily due to rising energy-related production costs and commodity price hikes. As we projected last quarter, prices for insulating materials, cement and concrete products are still rising. This is due to 1, strong demand, and 2, localized supply chain factors, which are both giving suppliers pricing power. In contrast, inflation for many other materials has now softened to low single-digit levels. Since August last year, we've seen an overall easing in the rate of material price inflation, with prices for primary materials like imported timber, structural steel and rebar all falling significantly. Although falling energy prices bodes well for the cost of materials, the potential for further volatile energy remains a significant upside risk in 2023.
In the labour market, we've experienced a fall in construction vacancies compared to the historic high levels seen in 2022. However, job creation is picking up pace due to stronger than expected workloads. With the labour market still tight, average weekly earnings in construction have risen by 3.7% on a year-on-year 3-month basis. This reflects the increasing demand for workers exceeding the available labour supply. To address the shrinking UK labour market and ageing workforce, the government plans to make it easier for skilled foreign workers to qualify for UK work visas by adding certain roles to the shortage occupation list. In terms of energy and transport, we're seeing positive developments. Wholesale energy prices have fallen, with natural gas prices dropping 89% since their peak in August 2022. While this brings relief to the construction industry, caution is still recommended. Cuts to oil prices and potential risk for a cold winter this year could lead to an energy cost surge. On the transport front, road haulage prices rose by 3.6% in April, but they are still lower compared to last year due to falling fuel costs. Shipping costs are below the 5-year average. Also, container shipping rates have decreased as recent supply shocks and trade disruptions have eased. In summary, input prices appear to be stabilising while labour remains on the watch list.
This quarter, our 3 key takeaways are: 1, ongoing demand is sustaining market activity, with the industry continuing to demonstrate its resilience. 2, input price inflation is easing and market conditions are improving. 3, with these stabilising conditions, an improving economy and anticipated capacity in the contracting market towards the end of the year, it looks like it could be a good time to build. As always, the market is constantly evolving, so please stay tuned for our future updates, where we'll continue to keep you informed.
If you want to find out the details behind the headlines, read about it on our Market Intelligence website. Follow our channels to keep up to date or get in touch to speak to one of our market experts today.